Hey everybody, welcome back to our channel. I'm Josh Tavares, investor and realtor with the Realty Brokerage. In today's video, we're going to actually talk about the different real estate investment strategies and find out today which one is right for you. So if you're right now a new investor or someone looking to get into a different type of investing strategy, this is going to be the video that is going to change and catapult things for you in your future. So remember to stay to the end. Before we continue, remember to hit the like button, hit the subscribe button, and hit the notification bell to get updates on our newly uploaded content. And without further ado, let's begin. Strategy number one, buy and hold. The buy and hold real estate strategy is essentially purchasing a rental property, keeping it for the long term, and seeing many different excellent benefits with real estate investing, such as asset appreciation, cash flow, forced appreciation, tax advantages, leverage, and more. This method has actually helped many real estate investors become very successful by having their own primary residence, refinancing it, and using that to purchase multiple properties and to continue in the same process with their rental properties to grow even more by refinancing and doing what needed with those properties to duplicate and multiply their portfolio. Or if you've got a lot of cash sitting around, you can essentially use those funds to purchase properties if you have the funds on hand to do so. Personally, we love this approach because over time, you're going to have a higher cash flow, you're going to have great equity that you can use to multiply, as I stated earlier, and that your cash flow is going to increase because of many factors, such as you're going to have less interest to pay over time, and over time, your property is going to increase in value, and guess what? Rents are going to increase, so that means more cash flow for you and your property. Strategy number two, fix and flip. The fix and flip strategy is essentially purchasing a rundown property, providing some cosmetic upgrades, increasing the value of the property, and then selling that property for profit. With this strategy, you need to make sure that you have everything in line. You need to understand the profit margins, you need to understand the market that everything's taking place, the cost of all your materials and labor. You have to understand everything well enough and know roughly what you're going to get at the end of selling this property. Because at the end of the day, you don't want to be one of those investors who get into fix and flips and after it's said and done actually own more than what they put into it in the beginning. And this is why it's super important to understand what's going on in the market, what's taking place in terms of cost of material, understand labor, and being able to manage the project. Because if you're not on top of things, you're going to have a lot more costs and you're going to have contractors trying to take more money from you, leading to less profit margins. And that's already bad enough that with financing for these types of projects, it tends to be a lot higher than conventional lending. Remember, with fix and flip projects, because it's going to be a very short time frame you're going to hold the loan for, you're typically going to pay between 10 and 15%. It's going to be a lot higher than you're going to see with the conventional mortgage. But remember, you're only going to hold that for a short period of time, but based on finding the right profit margins and the right property and having everything counted to a T in terms of your expenses and the potential revenue, you'll be able to see a high amount of profit. And then once you've been able to sell the property, you can duplicate and rinse all over again. Strategy number three, it's the BRRRR method, which is buy, renovate, rent, refinance, and repeat. Now, I will say that the BRRRR method is very much like strategy one and two, where you're essentially purchasing a rundown property, increasing the cosmetic value, and instead of selling the property, you're keeping it over the long term, in which you can use in a short period of time to refinance and duplicate your portfolio. This is the perfect blend of buy and hold, where you're essentially keeping the property and having the wealth generating elements involved, and at the same time you're able to get a high amount of value in a short period of time that you can duplicate your portfolio right off the bat, than opposed to purchasing a rental property that actually has no equity built into it and has already been renovated. With these type of properties, you're going to receive a high amount of cash flow. The reason being is you purchase it for such a little amount compared to have the property been renovated and you purchased it completed, that you'll have a higher cash flow because there'll be less expenses, less lending expenses, taking place. That makes it a lot easier for you to profit and have yourself be in a position to refinance and have a lot of passive income that'll help replace your 9-to-5 income. And this is the method that I highly recommend that you go about, because you're getting the best of both worlds. And if you're able to keep this going for a long period of time, you'll be able to duplicate your portfolio upwards to 5, 10, even more properties, and transition, if you want, from single family to multifamily and commercial within a certain period of time. This is one of the methods in which many real estate investors have started out and have been able to go about getting into different spaces, like I said, with commercial, industrial perhaps, and even multifamily. Strategy number four is investing into REITs, which are real estate investment trusts. Now, a REIT, a real estate investment trust, is essentially investing into a project, so a publicly funded company, in where you don't own the full property outright, but you do own shares of the company. So you are essentially an owner. And what I love about REITs is the fact that they tend to have a high yield. So yes, it is particularly like a stock where you are owning a share. You don't have as much power as you would with owning a buy and hold. However, you are still getting the appreciation. You are getting a high yield every single month in terms of cash flow being paid back, which is a lot better than some other stocks that you could own with other companies. Personally, REITs are fantastic for investors who are not able to purchase a rental property outright, are not able to receive financing. Maybe they don't have a great deposit, but it's a good way that you can invest some extra money. Let's say you've got $20,000 in the bank. It's not enough for a down payment in the area you're going about searching, or you're just not able to qualify for financing for whatever reason. You can invest into a REIT, have ownership, bank off the appreciation, and receive monthly yields. Also, the other positive thing with this is that you don't have to manage the property. You're putting money into a project in which someone else is managing, which is going to be management fees that'll be subtracted, in which you receive the leftover amount based on the number of shares you own. But it's something to look into, because this way you don't have to worry about managing any projects. Strategy number 5, real estate syndications. Now, real estate syndications are very much like owning shares into a REIT. The difference is you're investing with a high group of individuals who are probably in the same boat, where either A, they're unable to obtain finance and maybe they don't have enough for a down payment, or they're just real estate investors who have a high amount of cash flow, don't want to keep it in the bank, and rather have some sort of yield coming in every single month through dividends. And like I said, this is fantastic because you don't have to manage the property. You have other people managing it for you, and you can sit back, relax, and receive appreciation as well as dividend checks every single month. And syndications tend to lean more towards either multifamily, residential, or industrial, where you're going to need tens of sometimes hundreds of millions of dollars to purchase these types of investments, or they're existing. So these are the kind of things that you're looking for as the individual who's looking to go about raising capital, is that you're looking for a high lump sum of people who have good amount of cash, so you can go about investing into these types of projects. So there's two different ends. There's essentially those who are looking to raise the capital, and there's individuals who are looking to invest their funds into the capital, and same thing too with the REIT. And personally, investing into these real estate syndications is a lot more stress, and typically will probably have better returns because you're going to have a professional manager taking care of the property, tenants, and any problems that may arise with the property. There you have it, some helpful information about the top real estate investment strategies that you could start today, whether you're a new or experienced real estate investor. I'm Josh Tavares, investor and realtor with the Realty Brokerage. Thanks again for watching. Remember to hit the like button, hit the subscribe button, and hit the notification bell to get updates on our newly uploaded content. Thanks so much for watching. See you next time.